Yeah, welcome back. This is still Gozi Accounting Academy. Recall that in our previous video, we have introduced ourselves to assessing probabilities, particularly in the area of calculating expected values. And that is one way we apply quantitative techniques to in management accounting. In this slide, we are going to look at an example as to how to calculate expected values and how to use them. Now, if you look at the table here on the slide, you see that it has got about 4 columns. The first column here is on capacity, second column volume of production, third column probability, and the fourth column cost. So in the second row there, you have when there is 90%, if the company achieves 90% capacity, then volume of production will be 72,000, and then probability that they will achieve that capacity of 90% is 0.4, whereas the cost of production at that level is 19,000. On the other hand, if they operate at 100% capacity, then volume of production will be 80,000, and probability that will happen is 0.5, and then cost of production will be 20,000. Then if on the other hand, in the final row there, they operate at 110%, volume of production will be 88,000, and probability that will happen is 0.1, and cost of production will be 22,500. Now, what we are now expected to do is to compute the expected volume of production for the month, because you know there are 3 scenarios here. So what is actually the expected value which you can use in our budget or in other management decisions for next month? We want to compute that using those figures in this table. Now look at the second table there. If you look at the second table, you will now see all the units there under each of the capacities we have put in the first column, units. Then second column there, we have probability, and we have included a third column, and that is expected value in units. Now using the formula we gave in our earlier slide, which is outcome multiplied by probability to get expected value. So in the first or the second row there, if you multiply 72,000 with the probability figure of 0.4, you are having an expected value of production of 28,800. Now, if you do the same on 80,000 by probability of 0.5, you have 40,000. Now, if you do the same with 88,000 units by probability of 0.1, you have 8,800. Now, the total expected value, which is the last row there, will be addition of all the expected values. So you now have 77,600 units. So what does this mean? Even though there are 3 scenarios in the estimates, but we now have a single figure because of this computation of expected value. We have now a single figure of 77,600 which we can use in our budget for next month. So you can now see how assessing probabilities help us in management accounting to arrive at figures we can use in decision making. Now, what about the cost? You remember the first table also gave a cost of production per scenario in each of the capacities. So just as we computed expected value of production for each of the scenarios, we can also compute expected cost of production, total expected cost of production for the period. Now, that brings us to the last table there. You can see the 4 columns there. The first column is on production units, second column cost, third column probability, and the fourth column is on expected value of cost. Now, just as we did in the case of units of production, if we multiply the cost here with the probability values, we also get the expected value of cost. So in each of the scenarios, we have multiplied them out to get the expected value. For the first scenario, we have expected value of cost of 7,600. Second one will have an expected value of 10,000. And the third, we have expected value of 2,250. If you sum the three, we are now having a total expected value of 19,850 for the period. So that means for next month, our expected cost of production is 19,850 with expected value of production of 77,600. So you can see that with the computation of expected value here using probability techniques, we've been able to arrive at figures we use in our decision making. We can include in our budget, we can use for other things we do in management decision. So that is how expected values are computed and how they are used in management accounting. So remember, this is still Gozi Accounting Academy. Remember to like our videos and to subscribe to our channel. If you have missed our earlier slides on application of the quantitative techniques and how they are applied, sensitivity analysis, and introduction to probabilities, do well to watch them. We want to say goodbye for now. Thank you.